My name is Jake, welcome to the channel, and today's video we're going to do a Review My Pie video where I review subscriber portfolios. This is a series that I've had on the channel for the last couple of years. I really enjoy it. It's one of my favorite series here on YouTube. So, but here really quick, first off, I'm going to be traveling this week with the family. We're going to go and visit Grandma and Grandpa here so that Lucas can spend time with them, and so I'm going to be traveling, so I wanted to record the video a little bit earlier. And the other thing is my voice is still scratchy. I've been, battling with this cold this last week, and so I apologize for that. It's a little bit scratchy. So hopefully that's not too annoying. So in today's Review My Pie, what we're going to do is I'm going to answer a subscriber question that I got here recently, and then I'm going to go over 3 portfolios. The first is going to be from a 30-year-old here in the US, the second an 18-year-old from here in the US, and then the third a 41-year-old from here in the US. So a lot of here, from the US. If you're outside of the US, send me over your portfolio. I'd love to consider it for a future video. As always, the timestamps will be in the description below, as well as the portfolio links will be in the description below. And as always, everybody, I'm not a financial advisor. Don't take what I'm saying as financial advice. It's just merely for your entertainment. And speaking of entertainment, have you been following all of this with SVB and, the whole financial crisis and, everything that's going on in the market? It's pretty dang crazy. So, but yeah, I hope you're buckled up because it's definitely going to be a bumpy ride. Really the big focus is on the Fed and interest rates. When are interest rates going to come down? When are they going to pause? When are they going to cut? Like, you can't turn on CNBC or anything without hearing somebody talk about interest rates in the Fed, right? Like, every single person is talking about, is it 25 basis points? Is it 50 basis points? Are they going to cut now? Are they going to cut later? And it's like this never ending, are they going to do it? Are they going to cut? Are they not going to cut? And it kind of looks a little like this.
Be assured, this day will come. It's just a matter of time. Could be 1 month, could be 2 months.
3 months.
Could be
4 months.
I can see that happening, yes.
8 months.
That's a realistic timeline.
11 months.
Perhaps.
Oh my gosh. I love it. I love it. All right, cool. So let's take a look at the first question here. The guy here couldn't have wrote a shorter novel here for me, especially with my voice here. So I'm going to try do my best here to read this, and let's see here. So it's from Jeffrey. He writes, "Hi Jake, first off, I love your channel. I've directed numerous people to watch your videos to help them understand dividend growth investing and the great opportunity that it offers." Jeffrey, thank you so much, man. I really appreciate you saying that. I had a question that I had researched quite a bit, but I value your input greatly. I was at my wife's family house last weekend for a family dinner. Well, at the dinner table, we got into a conversation regarding finances, taxes, and investing. Oh, that sounds like a great conversation. Just don't talk about religion and politics. That'll be, yeah. I have my own opinions on this, but I always enjoy hearing others' points of view. So I asked the table if they felt you should always max out your 401k regardless of if you were trying to retire early or not. There was a unanimous decision at the table almost immediately that you should always max out your 401k regardless of retiring early due to the tax benefits that the 401k offers. Playing devil's advocate, I decided to spark some friendly conversation by asking if someone was to plan to retire early at the age of 50 or so, would it then benefit them to not max out their 401k and then redirect income into other investment options such as a taxable brokerage account, so that most of your investment funds are not tied up until 59 and a half years old, as you would need some form of other investments to survive off of until you can utilize the 401k as well. This sparked some great conversation and is leading me to write you this email. I would also ask your opinion on this topic. Is there ever a situation where it would benefit an individual or a family to not max out their 401ks so that they can retire earlier than 59 and a half? I am a facts and numbers guy. So if you know any calculations that reflect any said opinion, that would be great. I know there are a lot of information that goes into such as how much personal debt does one carry, or technically, you could access the 401k funds at 55 years old, and so on. But some form of overview on this topic would be greatly appreciated. Okay, really, really great question. I wish I was like a fly on a wall in that conversation. I'm sure that there was some friendly exchanges. So here, let me kind of share with you some thoughts here. So first off, I want to say that I went through this same dilemma about 6 years ago, 7 years ago. When I was first thinking about FIRE, I was like, well, everybody's telling me to retire, to max out my 401k. Everyone is telling me to do that. And it really confused me. And I will go so far as to almost create like some kind of like small bit of anxiety where I was like, am I making the right decision? I'm doing something that everybody else is telling me not to do. Am I right here? Is everybody else wrong? Or am I right? Are they wrong? So here's the thing. This is what I came down to, the realization that most people that you're going to interact with don't have the same goal as you. Most people do what most people do, and that is they go into debt, they spend more money than they make, and then they live the normal American lifestyle, right? And that's normal, and that's all they know. You're different, or at least you're thinking different. And that goes against the norm of what we've been told all of our lives, that it's normal to go to school, get a job, go into debt, and work until you're 59 or 67 or whatever age, right? And so it's counterintuitive to think that, well, I'm going to go against what I've been told my entire life, or, conventional wisdom, which is max out your 401k. It's because everybody says that that's how you do it. For most people that want to retire after the age of 59, that's absolutely the right way to go. Your normal person should do that. But I want to ask you the question, are you normal or are you different? And that's what you have to answer for yourself. Now, you don't have to be crazy, crazy different, right? But if you have a goal to retire earlier, well, then you have to take different steps to achieve that goal. And so you have to do a few things a little bit differently than the norm. And it's going to feel weird having a conversation with a bunch of people that are on a different track than you. They're on a different path. And so it can be very difficult. It's like, going to a friend's house, a friend that has kids, and you're single and over there on Tinder, right? It's kind of difficult to have a conversation because you're in different stages of your life, right? The guy over there on Tinder or whatever, like he's, chasing something else. The family with kids, they're probably exhausted, right? And so you really have to understand what's your path, right? And the thing that's, kind of unfortunate is because you are different and that's not the norm, you're treated as different. So your family members might look at you differently, or your friends or your social group might be like, well, that's weird. That's different. That's not normal. I don't like that. So just understand that it's very normal what you're going through for the type of path. If you're looking to retire earlier, be different. It's very normal for you to experience that. So you're not the first person that I've spoken with that has kind of shared that with me. And it's kind of relieving if you're in that situation where you're like, you're the odd one out and everybody else is telling you to do one thing, but you're like, well, wait a second, that doesn't make sense, right? And so asking that question is really, really important. Now, when it comes to, I'm not going to go into detail into this because it could take an entire hour, an entire video. But what I want you to do is I want you to take a second after watching this video, go and Google the Roth IRA conversion ladder. Okay, Roth IRA conversion ladder. That is a way that you can access your 401k before the age of 59 and a half. And it takes a lot, and it sounds like you're a numbers guy. It says here, a facts and numbers guy. This might be right up your alley. The Roth IRA conversion ladder takes a lot of planning, but it's a way that you can access your 401k before the age of 59 and a half. So maybe I'll make a video on it in a future video, but go and Google that after watching this video and you can thank me later. Thanks for sending over your question. I hope that this was helpful. All right, the first portfolio here is from Brian. He writes, "Hi, I'm Brian. I'm 30 years old and I work as a substitute teacher. I started learning about the stock market as a result of the pandemic, so I have only been investing for about 2 years now. I am still in the stage of learning and soaking in as much knowledge as I go, and rely on your knowledge and channel for tips and tricks." Okay, well, cool. So I opened up an individual account with M1, transferred from Webull. Originally, I wanted to invest in a dividend and reach FIRE, but the more I learned, the more I wanted to create generational wealth in a 20 to 30 year timeline. A lot of companies I invested in were for me being conservative and researching what I could as a beginner. A couple years later, I find myself constantly revising my portfolio without really having a second opinion. Now I want to learn about good research sites and tools that will help me better navigate my portfolio. I'd like to add my growth dividends, and I would like to add more growth and growth dividends and reduce any unnecessary holdings in my portfolio, as well as reduce my expenses. Thank you, Brian. Well, Brian, this is really great. I think you're a lot more common. It's a lot more common of what you're experiencing than you may think. So first off, from firsthand experience, I went through the exact same thing. M1 makes it so dang easy to create all these different slices, a slice within a slice. It's like a whole, inception over here, a slice within a slice. And they make it so easy, but it also, what I found, I kept going in circles. And it wasn't until I really simplified things and put together a methodical approach to how I view my portfolio did I really understand really stick with what I was doing. So first, right off the bat, what I'd recommend you do. So when it comes to research sites, it sounds like you're new to investing. My advice to anyone like you is to start with ETFs. Don't go and just start buying every company under the sun. Don't go on YouTube and watch the 5 best dividend stocks of March and be like, okay, I'm going to add the 5 best dividend. No, don't do that. Okay. Seriously, don't do it. In my opinion, the best approach, especially when you're first learning, is understand what the stock market is, understand what investing is, understand the different types of assets that you can invest in, really gain a knowledge around that first, and stick with ETFs. First, learn what an ETF is, and then as you become more knowledgeable, then you can venture out and start investing in individual stocks if that's what you want to do. But for the time being, what I'd highly recommend you do is approach this from the core and satellite approach to investing. Core and satellite, I've talked a lot about this on my channel. I will leave a link in the top, at the very end of this video. At the end of this video, I will have the core and satellite video pop up on the screen at the very end, and you can check out that video. I'll recommend that. That will help you if you're first starting out and you're trying to build your portfolio and you need some guidance. Okay, video at the very end of this one. Let's take a look at your portfolio. So you got a low expense ratio. You have a very high dividend yield. This is like crazy, crazy high. I can only imagine how many covered call ETFs you have in here or something. This is insanely high. It doesn't look like this is in a Roth IRA. You probably, dude, I think we got to go back to the drawing board. Okay, we got to rethink how we're approaching this, because you need to also understand what the total return is. And I've shared this on many, many videos, okay? Understanding what the total return is. The dividend is just part of the total return. You want to think about the capital appreciation and you want to think about the dividend. So you said you wanted to start doing research. Let me give you some homework. Go and research and try to understand what is the total return of investments, like of an investment, right? Understand the total return, because the dividend is just part of it. So you got 31 holdings. In my opinion, I would cut this in third, like in half. Like I would trim this to where it's on autopilot, and it is so simple. Before I dive into your portfolio, I want to give you a challenge. And everyone that's watching this video, if you invest, if you're married, if you have a partner, if you have a family member who you talk about with investing, I want to give you a challenge. If you're struggling with your portfolio and you can't figure this out, I want you to rethink your approach to how you're investing. I want you to think about your goal. Why are you investing? And then what I want you to do is I want you to put together a strategy and approach for your portfolio. And then I want you to understand it. I want you to internalize it. And then I want you to go explain it to somebody else. And once you explain it to somebody else, if that other person doesn't understand what you're trying to do, it's too complicated. Okay? This is perfect if you're in a relationship, if you're married, family member. It's a really, really great exercise. I challenge you to do that. All right, let's take a look at your portfolio. Let's see what you got in here. Technology, Affirm. What is Affirm doing in here? It's first off, it's It's 10% of your portfolio, way too risky. If you follow the channel, you know that nothing, no more than 5% in a single stock. What do you got in here? MPW. MPW has been beaten up. I am holding MPW. I own MPW. I have no plans of selling it. And even if they cut their dividend, this will be one of the very few exceptions that I would make. I have no clue if they're going to cut it or not. I mean, I have no idea. How would I? But unless there's like some kind of criminal or scandal going on in the company, I intend to hold it. So I will go as far down with the ship as B, but I think this is a long-term investment for me. This is not a short-term investment. The real estate ones, yeah, they're fine, I guess. What do you got in here? Zim. Oh my gosh. Okay, that's okay. Healthcare. Okay, finance. KB. I bought a KB house. Didn't like it much. They weren't very, very nice. Okay, this I like. 1, 2, 3, 4. I like this. I'm not as familiar with these ones. I've seen this one pop up here and there. These ones I like. What is this? ETFs? Okay. Staples. I'm breezing through here. You got some decent companies in here. They're pretty good. Levi's. Sure. I thought that was Chat GPT for a second. Okay, cool. So now I'm not going to go into detail into every single one of these companies because I don't think you're there yet. Based off of your email, I think you need to reevaluate your entire approach to how you're investing. What you probably did is you probably have watched a few YouTube videos. You probably have seen a Joseph Carlson video. You probably have seen, some of these videos here on YouTube, and you put together this portfolio. You're about a third of the way there, right? You've got the portfolio set up here. I think you need to take a step back and kind of get the foundation, right? First, understanding why you're investing. Why the heck do you have a firm in here and some of these other companies in a dividend portfolio? Is this even a dividend portfolio? We need to go back to the drawing board and understand what is your goal. And another thing, you have a lot of growth. You have mixed in here growth and dividend. I would recommend splitting them. You can have multiple brokerages. I would split the brokerages. I'd have a brokerage just for dividends, and I'd have a brokerage, if you want it, just for growth. Separate them. That's just my opinion. But what I would recommend is this right here. When you learn about the core and the satellite, these 4 ETFs, in my opinion, for you, should make up 80% of your portfolio. 80. Okay? And then if you want to have additional companies, well then, yeah, you could add 1 or 2 or 3% into JP Morgan, into Wells Fargo. Go for it. That's completely fine. But I promise you, if you don't have an approach like that, where you're just kind of like at random, kind of fiddling around, maybe this, maybe that, I promise you, that will never stop. For years, it will never stop, and it will create a lot of anxiety. It will create a lot of stress and emotions, and you're not going to stick to it. And you're not going to understand what you're invested in. So that would be my suggestion, is really see how you can simplify this portfolio, make it so that the overwhelming majority is in high quality ETFs based off of your time horizon. You can watch a lot of videos on my channel where I talk about that. But this should be your core, your bread and butter. This is what the majority of your net worth, in my opinion, given what you've explained in a very short email, this should be your foundation. So I hope that helps. Brian, thank you so much for sending over your portfolio. All right, the next portfolio is from Colin. He writes, hello, my name is Colin. I live in the US and I'm 18 years old, about to be 19. My time horizon is 20 to 35 years and to hopefully retire early if I can. I love your feedback and criticism. All is helpful. Thank you. Love your channel. Thank you so much, man. So first off, a 20 to 35 year time horizon, that's a big, there's a big difference between 20 years and 35 years. So right off the bat, whenever somebody tells me, yeah, I got like a 20 to 35, 40 year time horizon, that means that they don't know. And that's okay, right? How should you? You're 18 freaking years old, man. Like, you should be playing like Fortnite or like, well, Harry Potter. I don't know. Like, you should not be too stressed about your financial future at 18 years old. Okay. But kudos to you that you are, right? So, right off the bat, when you think about your portfolio, I want you to know that you're not going to have all the answers today. So, don't stress that you have to pick all the winners and then it has to be perfect from day one, right? How many people go to college with an idea that they're going to graduate or in this degree, but end up switching majors 10 times, right? Happens all the time. So go into this with an open mind, flexible, and just understand that your priorities in life may change. And because of that, what I'm going to tell you is going to be based on more of a flexible type of approach to investing. All right, let's take a look at your brokerage account. So your taxable account, you got a good dividend yield, very low expense ratio. You have a lot of holdings. You're 18 years old, 36. I'm skeptical. I'm skeptical in theory for an advanced investor, somebody that is like very nerdy. Are you a nerdy guy? Probably nerdy. Your name is Colin. Is Colin a nerd? Yeah, you're definitely a nerd. Now, Colin, let me back up. This is a great approach if you can stick with it, but I'm skeptical that you're going to be able to stick with it. But let's just run with it. I like your dividend yield. The reason why is you're not going to be taxed too heavily. The dividend is just part of the total return. If you have a long-term time horizon, you want to focus more on the growth so that you can take advantage of that miracle thing called compound interest, right? That wonderful thing, compound interest. Technology, what do you got in here? You got Meta, Microsoft, Apple, and Google. Okay, 25%. Okay, I can get on board with that. Me personally, I would. Okay, do you want to hear my? Okay, this is just me being a boomer. I'm a millennial, but like boomer mindset. You don't know if these companies are still gonna be dominating the market in 20 years. They probably will, but who knows? So maybe consider having like a technology ETF or an ETF that has, a heavier concentration to technology. I don't know, just kind of a thought. Let's take a look. What do you got here? You got growth ETFs. Okay, I may have spoke too soon because they're right here. VTI, VGT, SPYG, SEHD. I love it. Great. What you could consider is you could even consider like a DGRO. DGRO would fit very, very well to this time horizon. Hey, I mean, DGRO would look really, really nice here. You could lower all of these and put in some DGRO. Why not? All right. I don't hate it. I think it's fine. The 30% in Amazon, it's 5%. Okay, it's fine. Healthcare, what do you got in here? Okay. Good healthcare companies. Semiconductors. Okay. Probably feeling the pain with Intel right now. Didn't Intel just cut its dividend by like 60%? That is why you don't have more than 5% in an individual company. I want to create a single video and just like say this on repeat. Don't invest into one company and have it be more than 5% of your overall portfolio. Like, you don't know if Intel is going to do great or if it's not going to do great, right? Like, I feel like an old grandpa saying this, but like, I don't know how many times I got to repeat myself. The thing is like, it's just too much unnecessary risk. You can't predict the future. You don't know what's going to happen, right? Like 5 years ago, you would have been thinking you're the smartest man alive, right? But then things happen and, it's just too much risk. That's why I don't have more than one company be more than 5% of my overall portfolio. These are all really, really good. I'm looking for like speculative companies. These are fine. MP Materials. Speaking of speculative, wasn't that a SPAC, Shamath or something like that? Maybe not. Maybe it wasn't. Maybe it was. I think it was. Okay, sure. Industrials, UPS, Caterpillar Waste Management, Lockheed Martin. Love it. Communication services, Verizon, Comcast. Cool, cool. Energy. Oh, you've been listening to my channel. This is good. I like this. For your time horizon, you got the right utilities in here. Good utility and utilities. These are good utility companies. So overall, with this portfolio, I think it's fine. Like honestly, like the biggest threat to a portfolio like this for an 18-year-old is you're going to obsess over this and you're going to be, contradicting yourself and second guessing yourself. Contradicting is not the right word. You're going to be second guessing yourself if you made the right decision. Should this be 10% or 20% or 7%? Like that's the biggest fear that I have for someone like you, that your emotions can easily overwhelm you. And when the market is at all-time highs, you're going to feel like a genius. But when a bear market comes, you need to make sure that you're in companies that you understand so that you don't sell, irrationally out of, a spike in emotions. And a great way to prevent that is holding high quality dividend growth ETFs. So that's my take there. Let's look at your Roth IRA. Your Roth IRA is doing pretty decent. What do you got in here? So you got 1.75. I like that. A decent expense ratio and 4 holdings. I really, really like this. Why can't your regular brokerage account look like this? Why does it have to look like this? Like this is great. Like this is simple. It's easy. You can understand it. Let's take a look at it. I mean, look at this. This is great. VTI, VGT, VIG. You could substitute that with DGRO, but that's cool. You can go with it. And SEHD. I like it. Okay, so at the beginning, when I was reading your email, you said that, when I said, focus on flexibility, this is what I was referring to mostly with the flexibility. For a 20 to 35 year time horizon, there's a lot of gaps, and there's a big difference. The reason why I like VTI is you have options. The reason why I like VGT, you have options. SEHD, you never want to sell. VIG, ideally, you never want to sell. But in 35 years, this is growing so exponentially that you could then, in 35 years, go around, buy a house, buy a car, buy something or do something in your life when you're 60 years old, or flip it and buy more SEHD or buy, a covered call ETF like JEPI. I really like this. This Roth IRA that you have right here, I would give it an A+. I love it. I think it's great. As an 18-year-old, I really, really like this. I think this is, I give it an A+. So thank you so much for sending over your portfolio. Your Roth IRA, spot on. Your individual portfolio, maybe take a look at it one more time. Just ask the question, does this really make sense? Do you really need to do this? And if the answer is maybe or no, then you know what to do. Thanks for sending over your portfolio. All right, the last portfolio is from Thomas. He writes, "Hi Jake, I've been enjoying your videos. Please give me some feedback on this simple portfolio in my taxable account, which I'm contributing on a regular basis. I'm a 41-year-old, likely to retire in 20 years. Okay, so that means if you're going to retire in 20 years, that means that you will be over the age of 59 and a half. So the very first thing, if you know that you're likely going to retire after the age of 59, this is what we were talking about earlier, with the question from Jeffrey, is making sure that you know which account to be investing in, right? And so in your case, a Roth IRA is the very best account, in my opinion, that you could be investing in with your time horizon as you state here, looking to retire after the age of 59 and a half. All right, let's take a look at your portfolio. The last 5 years, you're up 44%. You got 4 holdings, dividend yield of 1.8, and a low expense ratio. This is very similar to our friend Colin here that we were just taking a look at. So what do you got in here? You got SCHG, the large cap growth. You got SCHD. You got VBR. And you got SCHV. Okay, this is really interesting. So in order to kind of, put this into perspective, I think, you're trying to diversify across different asset, different pockets of the market. You're going after small value, you're going after large value, you're capturing kind of, more large value, value and growth with SCHD, and then more large growth with SCHG. So you're kind of using kind of like a shotgun, no, excuse me, a sniper rifle, and you're trying to pick which part of the, which pockets of the market you want to have more exposure to. And I think that, generally, I don't see anything wrong with that. I think that's fine. You may want to ask the question, well, you are pinpointing specific pockets of the market. Well, if you take that approach, have you considered international, right? Like, is international going to be, something that you want to consider? I don't talk a lot about international, but because you have this type of approach, have you even considered like 10% into an ETF like VXUS as an example? But in general, I think these are great ETFs. The question that you have to ask yourself is this allocation going to beat just the S&P 500 or, the total US stock market? And so in order to actually, see that, back test this, what would have been the historical performance if you would have gone with your approach with your portfolio versus, for example, just going with VTI, the total US stock market? Is it worth, pinpointing or picking out specific pockets of the market that you prefer? And I honestly, I didn't know the answer. And so I thought, you know what, let's just take a look in Portfolio Visualizer and let's see what the results would have been. So this only goes back to January 2012. Okay, so it's not a ton of data. It's 10 years or so. And so when looking at that, you can see Portfolio 1 is yours and Portfolio 2 is just the US stock market. It looks like your portfolio over these last 10 years has actually outperformed the total US stock market. So in this case, your approach has actually, has paid off. And I think the big part of why that is, it's primarily because of this right here. Because SCHG has performed so well since 2012, this has been really that big driver. And so I believe that growth will continue to outperform value in the long term. So I don't necessarily, I have no idea, I have no crystal ball, but I think over decades, I think this type of allocation will likely outperform the total US stock market. Now, to what degree, I have no idea, but just generally over time, in decades, generally growth outperforms the total US, it tends to outperform. And when I mean outperform, I mean outperform the market, and in this case, the total US stock market. So this type of approach can work very, very well. If you wanted to play around and see, okay, well, what would what has been the historical performance if I would have done, well, let's say 30, 30, and then 20, and then 20, for example. I'm just spitballing here. The return would have been a little bit different, right? So then your portfolio would not have outperformed as much. But once again, it's coming back to because you have such a higher weighting into the growth. That's why you're gonna see that higher performance historically and over decades, likely in the future as well. So all in all, I like the portfolio. I like that you keep it simple. There's only 4 holdings. You have a strategy behind it. The one thing that you want to be careful of is you don't want to find yourself playing with this and changing it every single year. This type of portfolio, it's really designed to set it and forget it. This is not a portfolio that you log into and check it every single day, every single week. That's not the goal of this portfolio. So I hope that that's how you're approaching this and that you're not actively managing this and on a regular basis changing the percentages. That's just, in my opinion, not how this type of a portfolio should be designed for a 20-year time horizon. So I hope that helps. Thank you so much for sending over your portfolio. Thank you so much, everybody, for watching. I hope that the video was helpful. I hope that my voice wasn't too scratchy. And yeah, I'll catch everybody in next week's video.
So please, whatever, I want to reach 1 million likes. Okay, thank you.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.